Are you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. I'm going to simplify the lending world for you. My name is Paige Ashby. As a mortgage broker of 21 years, one of my most asked questions by my clients is how to better understand the language used by the loan officer, or how to simplify the loan process so that they can make the best decision for their biggest investment, their home. In this episode, I'm going to break down the loan programs. This will allow you to understand what your loan officer is talking about when you're in the process of getting a home loan. Let's get unpacking. The first program I want to talk about is conventional loan. Now, a conventional loan is any mortgage loan that is not insured or guaranteed by the government, such as FHA loan, Federal Housing Administration, Department of Veterans, which is a VA loan, Department of Agricultural Programs, which is a USDA loan. Another name for conventional loan is conforming loans. So if you hear conforming loan, it just means that it meets the requirement for Fannie Mae or Freddie Mac. There are two types of conventional loans, fixed or adjustable, which is an ARM. Now let's go into details for a purchase. The requirement for a purchase on a conventional loan is 5 to 20% down. Anything less than 20% down, you're going to have that mortgage insurance, which is a monthly mortgage insurance, which is also less than the FHA loan, which we'll get into the government loans. Now, first-time home buyers also has the option with a conventional loan to put only 3% down. Now, there are restrictions on these programs, limited income or limited area. So it depends on the area, which is a low income area. Your loan officer should have a website that they can search and make sure you qualify for that if you find a house in a certain area. And then also there's a max income that you can make as a single borrower or as a married couple. So they'll do some research on that and see what you qualify for. But also conventional loan, there's tons of grants. You might want to check into that with your lender. There's lots of grants for conventional for first-time home buyers. It does limit the income, but every area has different limitations. So definitely check into that because that's a great way of buying a home for the first time. Now, if a borrower does not qualify with a normal documentation, as in W-2s or tax returns for self-employed, there's an amazing program called non-QM, non-qualifying mortgage. So for example, if you're self-employed and you don't qualify on paper, because you do make the money, but you have a lot of write-offs, so on your taxes, you do not qualify for the loan, there's also an option called the non-QM, which is a bank statement program. So what happens is you can provide 12 to 24 months bank statements. Then the lender will use the deposits for all the 12 months and they divide by 12, and there's a factor for expenses. It depends on what kind of business you're in. So your loan officer should walk you through that. But it's a great tool for self-employed people that have a lot of write-offs and don't show income on paper. Bank statements, business bank statements, personal bank statements is qualifying, but of course we have different factors to use that income. Now, a really good popular program lately for investment property only is called DSCR. Now, these programs allows you to buy properties that are for rentals, and you do not use your income to qualify. It's amazing. You do not use your personal income to qualify. How the qualification works is they use the rental income in the area, which there will be a worksheet that the appraiser has to include in the appraisal. So the average rental income in the area is what they come up with to use as income to qualify for this. So it is a great program for just ordinary people to start building their portfolio and buy rentals. You do have to have 15 to 20% down. So if you have the down payment, but you can't qualify with normal income as tax returns or W-2, this is a great program for you to take advantage of the rental industry without being an investor. So that's really good for a startup if you want to get a second home or investment property. So the last program I want to talk about is a non-conventional loan. It's called jumbo loan. So jumbo loan is any loan amount over the county limits. So every county limits has a max loan amount that you can use or purchase. So anything over that is called jumbo loans. Now those are going to have a little bit of a higher rate, but it just depends because jumbo markets are very iffy in the secondary market. It goes up and down as in the rates. If someone the lender wants to buy more jumbo loans, then of course the rates will be more attractive. But most of them are going to have a little bit higher rates and of course higher credit scores required for jumbo loans. Conventional, you can have about mid 600s to 840 or 900, the highest. So that will be for borrowers that have stronger credit scores and more reserves for the jumbo loans. All right, so I like to go into government loans. It's pretty interesting. There's a lot of government loans. There are FHA loans, which is the Federal Housing Administration. And let's go through that. The FHA loans does allow you to have lower credit score. I mean, some lenders go down to a 500. I do those loans all day long, in the low 500s and mid 500s. That allows you to get an FHA loan, but it does have 2 mortgage insurance requirement. So mortgage insurance is for the lender to insure the loan just in case you default. That's how they insure their loan. Now you have 2 kinds, upfront and monthly. The upfront mortgage insurance is 1.75 and the monthly mortgage insurance was 0.8 to 0.85. It is lowering. The new adjustment is going to lower that by 0.5 to 0.55, which is a huge advantage right now for anyone that's interested in buying and you really couldn't afford that monthly payment because the mortgage insurance was so high. So with this will give you an advantage to get a lower payment. This insurance will stay on the loan for the lifetime of the loan unless you put 10% or more down, okay? Then it stays on the loan for only 11 years, or you can refinance out of it. That's how you get rid of it. So I have so many clients that ask me, when does my mortgage insurance come off? Well, on an FHA loan, it does not unless you put 10% down or you have it for 11 years, then it does come out. But other than that, which most of my clients that have FHA loans, they put, of course, the minimum requirement is 3.5% down. So most of the time it will stay on there for the life of the loan. Now, FHA does allow you to have or to do a cash out, which is if you want to pull cash out to do any home improvements or debt consolidations, you can cash out up to 80% max of the loan to value, meaning whatever your house gets appraised at, you can cash out 80% of that. So if you owe an amount, you have to add that in minus the 80% max amount, then the difference you can pull cash out. Those are great right now because credit card rates are super high. And most of my clients I do are cash out refinance just to be debt free, wipe out all their debts and just have a mortgage. That will be a huge stress relief with the market, what's going on right now. So another FHA loan that is available is called Streamline, aka rate reduction. So most of the clients that have an FHA loan, as long as they make at least 6 payments, they can do a rate reduction when the rates are better, obviously, because, rates are not that great right now. But when the rates are better and they can do a streamline, it is such an easy loan process, meaning there's no income docs needed. We don't need pay stubs. We don't need tax returns, we just need to do a verification of employment if you're a W-2 employee, or you are self-employed, then we just need to prove that you're in business, a business license, a CPA letter, but we don't need numbers because the purpose of this is you have a high rate and you want to do a rate reduction, lower it. So they know because you can afford the higher rate. So when you're going down to a lower rate, that's why there's no income docs needed. They just want to make sure you do have a job and you are employed. Another benefit to this program is there's no appraisal needed. So what happens is they'll just do an estimated value and there's no actual inspection appraisal and you don't have to pay for an appraisal. So that's a huge benefit on that. All right, so the next program I want to go through is the government loan, which is the VA loan. Now these loan is from the Department of Veterans. VA loans are for veterans. The benefit is on a purchase side is there's no money down. It's 100% financing. So veteran loans, you can go 100%, no money down, and there's no mortgage insurance on these. And they can go up to 100% on a purchase. And on a cash out refinance, you can go up to 90%. No mortgage insurance on either one. So VA loans does have a funding fee. Okay, now if the vet does not have 10% or more disability benefit, you do have a funding fee factor in there, just like the mortgage insurance, the upfront. They do not have the no monthly mortgage insurance. Now, if your borrower does have 10% or more disability, this funding fee does get waived to zero. So there's no upfront funding fee for anyone with 10% or more disability benefits. The certificate of eligibility will be pulled to make sure their entitlement is opened for them to do the loan, is available. The amount will come straight from the VA website, which your processor or your loan officer will pull it for you and let you know. Now, the funding fee does vary on the usage for purchase or refinance. So that will determine by your loan officer, and they'll let you know what the factor is, because that actually is changing too. So make sure you check with your loan officer on that. Now, so it's great to do a cash out for VA because there's no mortgage insurance, monthly mortgage insurance, and you can cash out up to 90%, which is a little higher than conventional and FHA. That's the big benefit. And then also, VA does allow you to do a rate reduction. It's called an IRL instead of a streamline, as the FHA is called. So VA has a rate reduction program that's called IRL. It's a huge, huge benefit because, again, there's no income docs, just like the FHA streamline. There's no appraisal needed. VA loans does limit the lender to charge you with fees. There's a list that they cannot charge you for a certain kind of fees, and then there's a list that what they can charge you. So that protects the veteran. So that is a great program for your client if you want to do a rate reduction. The last government loan that I want to go over with is called a USDA loan. It is an agricultural program. It's for rural properties. Now, the qualification is there is a restriction on the area and the income limit. So there's a website that your loan officer will search and make sure you're in the area that qualifies you for rural property. And the benefit of this is, huge benefit actually, of this for a purchase is zero down. It's 100% financing. So that will help people that are not having enough money for down payment, but they have the income to qualify. And then also this allows you to do a rate reduction refinance if you need to lower your rate. Now on the USDA loans, you only can do a rate reduction refinance. There is no cash out allowed. So most of my clients that have a USDA and they need to pull cash out, what option I give them is they can just do a FHA cash out temporarily, just to pull their cash out, be debt free, or do any home improvements with their cash out, whatever's the need for the cash out. And then once they make there's 6 payments, 7 payments, I can get them back into the USDA loan for just a rate reduction if there's a benefit. Once, depends on the market, how it's doing. So on USDA, you only can do a purchase or a rate reduction refinance, no cash out. But yeah, these are just the basic program I wanted you guys to understand, so you have options and really know what you want to do, what kind of loan you want to qualify for, and all your options when you are looking for a house or talking to your realtor, or when your loan officer's talking to you. At least you understand a little bit of these programs. Now, if you enjoyed this information, make sure you give me a follow. And if you have anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and mentor, if you have any questions, you can reach out to me through LinkedIn. It's Paige Ashby Lending. Thanks for being part of the Unpacking the Home Advantage. Have a great day.